Today we met with a client who was looking at getting an overdraft facility for their business. They're looking at about $30,000, nothing too huge, just to make sure they had money for a rainy day, and also to make sure that if they had an opportunity to buy stock, a bulk discount, whatever it may be, they had the opportunity to move quickly on that and not find themselves in a position where they needed money and didn't have it. So when we get clients come to us, especially for these smaller ticket overdrafts, the main decision we have is, do we go to a bank or a non-bank lender? The general rule of thumb is the bank's going to have a much lower interest rate, potentially higher fees, slower and harder to work with, and may ask for more income documentation. The non-bank's going to be faster, require less information, will have a higher interest rate, but important to note, will often have a lower fee. So this is quite important, and oftentimes the decision comes to how much you're actually going to use this facility. So to give you an example, we get clients who come to us, they've got a great business, they've got money in the bank, they don't need money, but they like having the peace of mind of having an overdraft. For them, knowing they're not going to use it very often and knowing that it's there for a rainy day and they might draw it down for a week to pay a supplier, for example, having a facility with a higher interest rate but a low fee and the ability to pay it back early means they can effectively draw down 20, 30 grand, whatever it may be, pay the supplier, pay it back within a week, and the overall cost of that loan is very little because they've only had the money drawn for a couple of weeks. On the flip side, if they went with a bank, they'd be paying a line fee or a account fee that might be quite large, and even though the interest rate's cheaper, the line fee applies whether or not you draw the money or not, whereas the interest only applies when you draw the money. And so what that means is if you're going to be drawing the money a lot, you want a cheaper interest rate and the line fee potentially less important. If it's a rainy day fund, you want to focus on the fees and line fee and less on the interest. And so our general rule of thumb is if you're not going to be using it regularly, let's focus on something that's lower fee. If you're going to be using it regularly, it's going to be fully drawn, let's focus on something with a lower interest rate or lower cost, assuming it's drawn. And the advantage is we can always change this. So oftentimes we may set up an overdraft facility for a client, that gets fully drawn, and they then decide, actually, we've had an opportunity for growth here, we've drawn down this 100 grand overdraft, we've bought some stock, bought some new staff, or whatever it may be, and that's going to be drawn for a few months. We'll then refinance that from a more expensive facility with lower fees to something that's got a lower interest rate because we know that loan's going to be drawn for the next little while. So it's important to remember it's not always the interest rate that matters when getting a business loan. You want to make sure that you're looking at the fees, the interest rate, the speed, and I guess particularly how that applies to you, and try and get an idea of what your cost is going to be depending on how you use that loan, as that's going to help determine what product you go for.